A very good morning, good afternoon, and good evening to all our listeners. We're pleased to have more than 215 people joining in from more than 21 countries. Today's update was mainly focused on accountants. However, we have business owners, we have people from the banking fraternity, as well as stakeholders of various nature attending today. And that made me wonder, why are there so many different types of people attending an accountant's update? The reason is simple. Accounting is at the very heart of every organization. The management, if you read any financial statements, is tasked with governance, are responsible for preparing financial statements. We, as your auditors and business advisors, are here to not only guide you, but also help you make smart decisions. So today we are going to be listening to David Chitty, who is our Global International Audit and Accounting Director. David, in his role at the network, given his background as an audit partner at leading UK firms, has exposure to regulators not only from the Middle East, Africa, Asia, but also Europe, as well as standard-setting bodies from North America. We also have useful insight from Sanket, who is part of the MasterCard risk team, and he'll be sharing his insight on how you can manage your risk in your organization and how this implicates your accounting. A colleague of mine from the banking fraternity asked me if leases will be covered today. Leases is a separate topic under IFRS 16 and requires in-depth analysis. But what I can say to those who are listening and for whom it's relevant is it does impact your accounting. The way leases are accounted for now has brought forward and made the financial statements, made the balance sheet top heavy. So it's very, very important that you listen in today and you ensure that you ask questions. We do have a chat box. We will try and answer them during the session today. If you're not able to, we will be writing to you, and you can also reach out to any of the speakers through our social media. And of course, there's been a lot of people who were not able to attend today's session. They will be able to listen to this and view it on our YouTube channel, which will be posted on our website on the event section. So without further ado, I'd like to start with the UAE National Anthem. Thank you. This really is a remarkable period. The UAE celebrates its 50th National Day, and Crowe in the UAE celebrate the 40th successful year of operations in the UAE. Of course, our network is more than 100 years old, so we're proud to be living our Crowe Global core values. And with that note, I'd like to now request my colleague Dilip, who is the firm's independent quality director, to please switch on his camera and welcome the forward speakers. Thank you all for listening in, and thank you for investing your time with Crowe. Thank you. Dilip, over to you, sir.
Thank you, Zaid. I'll invite Mr. David Chitty to take up his session, which is on IFRS with focus on the going concern. I'll share the presentation, David. Over to you.
Thank you, Dilip, for the welcome, and it's a great pleasure to join you all today for this knowledge sharing series. I'm speaking to you from southern England on a cold, frosty morning, I have great pleasure in joining you today, both on the 50th anniversary of the UAE, and I congratulate my colleagues at Crowe in the UAE on the 40th anniversary of their firm, and I congratulate my colleagues for their contribution to the development of the UAE over much of its history, and as it's developed its success and its contribution to both the regional and the global economy. I've been asked to speak to you today for about 20 minutes on going concern, and it's going concern in the context of reporting in IFRS. This is an area that has received a lot of attention, of course, over now the nearly 2 years since we first had the economic disruption arising from COVID-19. And all of you who are leading in business, these are disclosures that you do need to give consideration to, that will be on the discussion agenda with your auditors, and I'm afraid that you simply can't ignore. But even if we were not in the times of economic disruption and societal disruption caused by COVID-19 and its continuing effects, all business leaders have to be conscious of the disclosures required about the going concern concept, make disclosures, and be aware of the risks to going concern, whatever they might be, and be prepared to comment on how you're managing those risks, because say the risk, the uncertainty could say come from the renewal of a key contract. You'll be expecting that contract to be renewed, but there's still a degree of uncertainty until the renewal is in place, and appropriate and measured disclosure about that risk has to be given. So Dilip, if we could move on through the slides, please. So we move on to this slide. Let's just remind you of the requirements that are set out in International Accounting Standard 1, the standard that's about the overall presentation of financial statements. And what IS1 states is that when preparing the financial statements, the management shall make an assessment of the entity's ability to continue as a going concern. An entity shall prepare financial statements on a going concern basis unless management either intend to liquidate the entity or cease trading, or has no realistic alternative but to do so. When management is aware in making its assessment of material uncertainties related to events or conditions that cast doubt upon the entity's ability to continue as a going concern, the entity shall disclose those uncertainties. Now, what that means is the going concern concept is our normal basis of accounting. But if there are uncertainties, if there are material uncertainties, then management need to give disclosure about those uncertainties. And where does the auditor come in? Well, the auditor, of course, will question you about your uncertainties. They'll question you about the quality of your disclosure and regard your auditor here as being somebody who can help you. It's not the auditor's role to write these disclosures because the auditor is independent, but it's the auditor's role to challenge you to make sure that the disclosures you present are transparent and give trust, give confidence in what you are presenting. So we've returned really to a re-emphasis about the importance of these disclosures due to the COVID disruption, and it's reminded us it's a much broader risk-based consideration. It's considering what uncertainties might give rise to a threat to the future of your business. So you, the leaders of the business, you, the management, you, the leaders of the business, you're responsible for assessing whether your business is a going concern and what uncertainties there might be that could be a threat to that going concern. Now, IAS 1 states that in making that assessment, you should take into account all available information and you're considering a period of at least 12 months from the end of the reporting period that you're reporting on. So when you're reporting on the year to the 31st December 2021, you're looking at the 12 months through to the end of December 2022. Now, some reporting frameworks in some countries have taken this further. So here in the UK, where I'm speaking from, it's taken further. It's taken 12 months from the date of the audit report. And there's a lot of good practice in that. So when you are discussing these disclosures with your directors, with your non-executive directors, if you have non-executive directors, with your auditors and your other advisors, going further than 12 months, there's a lot of sense in doing so, because that helps those who are relying on your financial statements, those who are placing trust on you, and those who need to take confidence from your actions. So 12 months, please regard it as being a minimum, but even if there's not a formal requirement where you are, be alert to taking longer. Then let me mention another standard. Another standard, IAS 10, is the standard on the events after the balance sheet date. Now that standard states that the assessment has to take into account events occurring after the balance sheet date, as of course will be all too aware to us all with the COVID situation, the way that it began to unfold during February and into March 2021. That was very clearly an event after the balance sheet date for a business with a 31st December 2019 year end, and then in February, March 2020, this began to affect us. But of course, there could be other events such as the status of a contract, the renewal of leases on key premises, renewal of the core finance for your business. Of all of these can happen after the year end. All of these are events that you need to take account of us. And IAS 1 includes a requirement to disclose significant judgments made by the management of the business in preparing and presenting the financial statements, and that includes judgments about going concern. So Dilip, next slide, please. Now we have here a graphic for you about applying the requirements of IAS 1 and what impact that then has on your disclosures. So The first scenario, there's no significant doubts about going concern. So you've assessed your risks, you've assessed your situation, you've got no significant doubts. So your business is a going concern. You disclose in the financial statements that one of the concepts is going concern, but there's no specific disclosures required. Now, the situation deteriorates as we move to the right. So our second scenario, there are significant doubts about going concern, but mitigating actions are judged sufficient to make the going concern situation appropriate. So maybe the doubts have arisen about the state of the market. Let's say the COVID situation as it unfolded in February and March 2020, and that impact upon the ability to do business to the level that you'd been doing business up until that point because of the impact of lockdowns, say the impact on, let's say, the ability of people to interact, the ability of people, let's say, to travel. So the disruption to the marketplace, or perhaps uncertainties arising from renewing lines of finance, and that then creates some doubts about whether finance will be replaced to the same terms and the same extent as you'd had before. So we've got some doubts, but there are mitigating actions. So in response to the market disruption, the business has adjusted its level of activity, it's found new lines of support, it's obtained, it's formed an understanding with its suppliers and with its customers. So the business has taken steps to continue. Or where there's uncertainties over the lines of finance, there's negotiations ongoing to arrange for new finance. We're again preparing going concern financial statements because that's the core concept in the standard. Now, do we then have to say something about the significant judgments made? So there are uncertainties, but we're addressing them, but we ought to be making disclosures about the significant judgments, even if they are mitigated, and really in the importance of transparency, say something about the judgments that have been made. Now, scenario 3, there's greater deterioration. There's significant doubts about going concern, but mitigating actions are judged sufficient to make the going concern appropriate, but the uncertainties remain after considering the mitigating actions. So the market disruption, the impact of that will remain. We don't know for how long. If I develop my market disruption story, perhaps we anticipate that we're operating at a lower capacity than we were for some time, and perhaps that's coupled with, as we're seeing in business at present, that's also coupled with higher costs than we had previously experienced. So that disruption continues. Perhaps there are greater conditions attached to the new lines of finance. Perhaps the new lines of finance are not as extensive as we had before. So when we prepare, we have to say that there are material uncertainties, and in the disclosures you explain what the significant judgments you've made are about those material uncertainties. And at this stage, the auditor may be thinking about making comment in the audit report, giving a paragraph that draws attention to the disclosures that you have made, because they are material and it gives information to the reader of the audit report about the auditor's considerations during the audit. The final situation is circumstances where the intention is to liquidate the business or cease trading, and there's no real alternative to do so. So if we use the technical terms in IFRS, an alternate basis of accounting is applied, which means you're not applying the going concern concept. Now, these aren't IFRS financial statements, because the going concern basis is one of the fundamental concepts. And the disclosure, there's not much in the standards about this, because of course the standards are designed for applying the going concern concept. So it's what you're preparing, put simply, is receipts and payments accounts with information about the state of affairs of the business. So this graphic does come from the International Accounting Standards Board and is a helpful graphic for helping you apply their standards. So let's move on to develop a bit more about disclosure and what makes a good disclosure. So on to our next slide. So the reporting implications. Now, we talk a lot nowadays in whether reporting or auditing about what is good. There's now too often the discussion has been about things that have gone wrong or things that have not gone right, but there's a lot of focus now on what is good and learning from the positives. So let's look at what makes a good quality going concern disclosure, and really think through this. If you've got any issues that you're considering as you're coming towards your year end, but equally just reporting how you are applying the going concern concept, and put out a good disclosure showing about how going concern is being applied in your business, and in fact that there are no uncertainties. But if there are material uncertainties, they're clearly highlighted and explained. That you clearly state the period covered by the going concern assessment. You give explanation of the different scenarios that you've considered, and because COVID-19 is on our agenda, I'm afraid very much remains on our agenda, so state the key COVID-19 assumptions you've used and how they've impacted your conclusion. State which inputs to your assessment have been subject to stress testing, and how the results of stress testing has impacted the going concern conclusions. Part of being responsible business leaders is to stress test your modelling, is to stress test your plans, and consider what range of outcomes might be and what impact they may have, and then identify and explain any mitigating actions that could be taken to improve liquidity, to improve the situation. So use this as a guide to help you prepare a good quality disclosure. Now, do remember that the disclosures you make about going concern should be consistent with other disclosures you give. For example, you'll be giving disclosures about impairment and the disruption to your business because of COVID-19. That may also have had an impact upon the value of some of your assets, so you may be reporting impairment. So do couple the two together, because why is impairment arising? Impairment is arising because the value of an asset has fallen because of reduced activity, reduced capacity. Going concern therefore may be a key judgment. And then as this final sum up point from this slide, remember the level of sensitivity analysis and the range of possible outcomes has been increased by COVID-19 because of the uncertainties. And as a very much live example, the emergence of the Omicron variant creates a whole new uncertainty as to what impact that might have and for how long that might have, that we literally wouldn't have considered until a few days ago. But it also shows us the importance of being alert to changes in circumstances and being ready to respond, and as part of your planning, being aware that new uncertainties may come along with new variants or new disruption, and build those in to your planning. So let's move on to our next slide, in which we are looking at the liquidity risks. Now, liquidity risks, I'm sorry I went on one slide. I do apologize to you all. Thank you, Dilip, for keeping me in line. So if we can, sorry, just let me finish looking at a good quality disclosure. So let's just go back a slide. I'm sorry, I was running ahead of myself. So continuing with our looking at good quality disclosures, do be alert to post-balance sheet changes, particularly where that may affect your financial position, and relevant disclosures in that area. And for those of you with 31 December 2021 year ends, the post-balance sheet environment is going to be very important for you to consider, as undoubtedly we're going to have additional uncertainties to the economy and the market caused by Omicron for some while to come. Do describe the nature of the facilities available to you, and do explain structural changes that you may be taking to your business that are needed to continue as a going concern, and indeed structural changes that you've got ongoing. So, and of course we again have the reminder in the box to the right. Again, all of this interacts with the other disclosures such as impairment, and that going concern is a key judgment, and everything that we're mentioning here links back to the sensitivity to the stress testing you're doing. And now we do come to liquidity risks. Now, liquidity risk is a key area of concern for investors in this disrupted economic environment, and the relevant standard here to consider is IFRS 7, because IFRS 7 requires quantitative and qualitative disclosures of your exposure to liquidity risk and how it arises, as well as disclosure of your objectives, your policies and processes for managing that risk and the methods used to measure it. So IFRS 7 is a disclosure only standard. It's long, it's detailed, but it's a very important standard for giving information about your business, and proper adherence to the standard is important, and the explanation of your liquidity and the risks related to it is key to supporting the going concern disclosures that we're discussing today. Now, particular key liquidity risks for you to consider are the thoroughness of your qualitative disclosures, including how liquidity risks have been managed, details of the facilities available to you, detail of the funding options available to you, changes in how in the risk and in how you're managing short, medium and long-term risks. You do need to present maturity analysis and give information about the maturity of your debt and other lines of finance. You do have to give details about your compliance with your covenants and other terms of financing, and there are requirements in IFRS 7 for disclosures about the seasonality of liquidity risks. So those businesses that peak at particular times of the year, because the nature of what have peak liquidity at both maximum funds available and minimum and maximum need to draw on their facilities because of the seasonal nature of their businesses. So for all of these, be alert to these thorough disclosures and perform the required sensitivity tests. So next slide, please, Dilip. Now, I mentioned earlier the alternative basis of preparation. I won't say too much about this because IFRS is about applying its fundamental concepts, and those include the going concern concepts. So there's not a lot said in IFRS about the alternative basis. As I've said, the terms often used are the terms breakup basis or liquidation basis are used, and I then used the term receipts and payments accounts earlier. So that would be the sort of model probably used if a business was being broken up, because it has only a short life left. Its assets would be presented at their disposal value. There would be provisions for contracts that need to be broken. Of course, all assets and liabilities would be shown as being short term and at what would be believed to be their settlement value. But if you're in this situation, you'd be taking professional advice anyway over the circumstances of your business and the management of the risks that come with the situation if you're facing breakup of your business, whether through insolvency or whether through the decision to cease trading on a solvent basis. So take professional advice. So to conclude this short talk, the key thing here is about being alert to risk, because going concern, a fundamental reporting concept, is about risk, and being transparent about how you're managing that risk and using the disclosure framework to present information about the way that you're running your business, about how you're managing the risks around you, and to give confidence in those that are placing trust upon the statements that you're giving, and be prepared to be challenged by your auditors, and be aware that your auditors may make comment in their audit reports about this area if you have material uncertainties. So it's been a pleasure to join you today, and I'll be back in a while to participate in the questions. If you have questions, please put them in the question box. So Dilip, back to you.
Thank you, David. And I would really thank you for this alternative basis of accounting, which has already answered a few of my queries, because I have come across some of such accounts in the recent past. We'll quickly move on to our next session. I will invite Mr. Sanket Shirvaikar, who is our external speaker for the day. Sanket, yeah. So now Sanket is a banker with a huge illustrious career of 24 years in the banking sector, and he's presently working with Mastercard. He's been in the Middle East, to specifically mention UAE, Egypt, and Saudi Arabia for the last 18 years. So we can just imagine how well aware or how deep his knowledge would be in this region. So at present, he is working with Mastercard, and academically he is having a doubles masters in commerce and in finance, both from University of Mumbai, India. So Sanket, quickly continuing from David's session now, having a viewpoint of a banker is very important in this current scenario of uncertainty, where the stakeholders, one of which is the lenders, the bankers, are very much concerned about the going concern visibility of the entities. So, and in UAE, you can see that we are towards post-pandemic era now. So, and recently there was a report, I think yesterday, that 100% of residents of UAE have been vaccinated, which is a great news to know. So now in this pandemic and post-pandemic scenario, what do you think and how you think would the methodology and calculations around expected credit losses would change? What I mean is the changes that are required in terms of the categorization and the customization of the calculations for the, or rather the whole assessment of expected credit losses. What is required to be done to address this uncertainty which is arisen out of the pandemic?
Thanks, Dilip, for having me here, and I think very interesting conversation so far. So basically, post the COVID pandemic scenario, there has been last year in 2020, a lot of central banks across the regions, they offered a moratorium period, right? And that typically meant that in the consumer banking world, there have been distressed accounts which have not really moved into the delinquency buckets. So for example, someone with a stress in his income who's not able to pay his installment has opted for a moratorium, and because of which his status has remained as, let's say, a bucket 1 customer, or as a current customer. He has continued for 6 months out of 12 months. So when you look at the outcome period and when you look at the default, these accounts wouldn't have gone into default, which otherwise they would have, right? So that directly impacts your probability of default. And that will probably create an incorrect picture when you calculate your expected credit loss, because typically you would see that the PDs have improved, especially in the distressed accounts, right? So one of the things that I'm sure the banks would have taken care of, but if not, they need to take care, is to remove these set of accounts which have opted for moratorium from your standard PD model, right? So they don't distort your PD model. There could always be an approach where you take a different PD treatment. So for example, whatever bucket they might be in, you take let's say a stage 2 PD for these accounts, right? Or you might take a stage 1 PD and kind of inflate that with a certain percentage to factor in the right amount of risk. But I think that is very important. You should not include these accounts in your PD model, at least for, I mean, next 12 months is what I would minimum, I would say, till you are sure that post the moratorium period, the customer has successfully made 12 successful installments, and then you can obviously move him back into the current book. But I think that's one thing that the banks need to take care of. The other thing that I have seen based on my past experience is that whenever there is something happening out in the macro environment, you could see certain fluctuations in your PD rates, right? So when a bank does a quarter to quarter PD refresh, you would see that the PDs suddenly improve significantly, which gives you a great release because of maybe one-off event, and that could also be true with the LGDs as well. So from a going concern perspective, the banks need to be more responsible. One of the things that you may not want to do is take the entire releases on a quarterly basis, right? At some point in time, you are tempted, if you are actually towards the last quarter and the year is ending, you might be actually tempted to take the entire benefit of the PD releases and end on a good financial year on your provisioning front, on your impairment front, right? But I think that's where that prudence comes in. You need to have certain floor limits wherein you say that, okay, fine, even if my PD has gone down from, let's say, 20% to 15%, at this point in time, I will take a floor of 20%, for example, right? One of the other best practices that I'm used to is you take average of the quarters. So I will say, okay, my previous quarter was 30%. This quarter it's gone down to 20%. Let me, take it at 25%. So I think some of those things are also very important. And I think all these things come in very relevant during these times when the times are uncertain. Right? We all are kind of talking about cautious optimism. So I wouldn't really encourage the banks to take the PD releases or the ECL release benefits at this point in time. I think you need to still wait for really this wave to pass through and things to settle down. Of course, it's quite positive. I mean, as you said, 100% of UAE residents are vaccinated, and the vaccination rate is increasing across the globe. But I think till the businesses stabilizes, till the pandemic is behind us, I would strongly recommend the banks to be conservative on their ECL approach.
Yeah. So I would point out two things which you from what you spoke. One is the calculations would require the exceptional items to be kept away. One, and second is very important, the prudence. Yeah. So now moving forward. So now when I see when these challenges are there, how do you see the challenges? What are the challenges that you see in implementing the IFRS requirements?
Yeah. So we'll see what typically happens is, so there are two teams, if you like, right? One is the team which is the enterprise risk that works in the bank and which is in charge of these models, the overall risk framework, etc. And then there is another implementation team, or the team actually which drives your numbers, which actually make an impact to your PDs and your LGDs and your EADs, right? So that's your kind of a consumer credit risk team. At times it happens that these two teams may not be really talking to each other. So when the models are developed, your model can only produce what you submit into the model, right? So as we always say, garbage in, garbage out. And based on my past experience, I have seen that this particular enterprise risk team, who was not really appreciative of how the retail products are performing, for example, credit cards or personal loans, they took certain rates, which of course that was an output of the model, but were not the right numbers, because what eventually got into these models were not accurate fields. And for example, I can tell you, for a market like in UAE, the credit cards loss given default was taken in the range of around 40%. Now, nowhere I have seen globally where, especially in kind of a transient population like UAE, you would get a loss given default in a cards portfolio of 35 to 40%. And I think that's where the involvement of the business teams, which actually are responsible for the risk, is very important. There has to be a discussion to say, okay, these are the numbers that the model is giving us. What do you think about it? What are your recovery rates, for example? Do you really recover 60% over a 3 to 4 year period? Or if your annualized recovery rate is only 10%, then does this figure seem to be right? And I think that's what is absolutely essential from an implementation perspective, right? I mean, these models were developed by big fives. They had been audited by central bank as well. However, from the model development perspective, again, as I said, the data which got fed into the model resulted into this output, but which was not really the correct output, and there were certain gaps in which the way the data was fed in. So it's absolutely important that to have the right levels of ECL, the business team that manages the risk has to be involved along with the enterprise risk team, so that you can relate the model output with the reality.
Okay, so again, two things which I note is, one is you have to carefully select what data goes in, and yeah. So having said this, now we do understand the working that a bank does on its customers. So the customers are us accountants and these entities. So we are now aware how the bank assesses the portfolio. So we should be aware of complying with the requirements of these terms of the lending agreements and the covenants. Now, thanks, Sanket. I'll invite Umesh, who is our partner from the Abu Dhabi office. Carrying forward from David's session, welcome Umesh. Carrying forward from David's session and Sanket's deliberation on these questions, now in this present uncertain scenario, the various stakeholders are very much again concerned about the going concern viability of the entities. So in the practical scenarios, what are the challenges that you see are faced by our clients while preparing the going concern assessment?
Thank you, Dilip. First of all, excellent insight shared by Sanket. And good afternoon to everyone, and good morning to those who are in a different time zone. Hope you all are keeping safe. Once again, thank you for asking this question, Dilip. This is a very relevant and important question, but at the same time, very complex. As far as I understand, this question should be interpreted in two parts. One, the challenges faced by the entity and how the remedial plan can be incorporated by the entity once they understand the challenges. Let me start the response to the first part by admitting that going concern is a very tricky subject. But the good thing is that this is not a new subject. Management was making an assessment for going concern always. They were preparing a business plan, projection with various prediction. But they were finding difficulty to meet this projection even before COVID. But COVID has brought altogether a new challenge with the kind of stress that it has created in the economic. So let's understand what challenges they are facing. The current major challenges faced by the entity are high degree of volatility in the market condition, significant change in the customer behavior, and long-term impact on various industries caused by this COVID. Now, what's happening? Management is preparing a budget. They're preparing a projection. But when they compare with the actual result, they realize that they're not able to meet the plan as budgeted. So they're going to revise this budget with incorporation of additional information as they gather with the day passing. And then they realize that, okay, the assessment previously made is not appropriate. They have to revise the assessment. So what this multiple revision would create is a confusion, a doubt on the part of the management whether their assessment of going concern is appropriate or not. So this broadly addresses a kind of challenges that the management is facing. Let's look at what kind of solution, a remedial action that the management can incorporate, implement. So the first most thing is to management has to acknowledge that this is a very complex process and this is very relevant process to be incorporated in the preparation of a financial statement. This requires involvement of a senior management and the business head across various divisions. So the division head could be sales, purchasers, the HR, finance. No need to take only the input from the finance sales team. So you need to have the cross-functional divisional head to be involved. Second, management should prepare a kind of robust and dynamic framework which can help the management to assess its ability to meet its obligation by considering all relevant information such as current, past, and the future information across various elements. I'm going to touch base on some of these elements. Then the third, this assessment should factor a certain key information such as changes to the customer requirement, their needs, demands, and also consider changes to the technology advancement impacting the business. Now, these information should be well incorporated into the business model, prepare a estimate, and consider whether any changes to the business model to be made. Once you decide to make any changes to the business model, there is a requirement for you to consider additional capital investment and also requirement to manage the working capital changes. Once you have this thing, the fourth most important is whether the management has the capability to raise additional funding. If they need to raise additional funding with a distressed market situation, what is their capability to raise the funding at a optimum interest rate, whether that would support their business plan. So some of these attributes could help them in preparing the assessment. then what would happen? You have the challenges, you have the attributes identified. Then the last most important action that the management should take is to corroborate these assumptions with the supportive information. What are these supportive information? You can't just build a projection with significant growth, even in the distressed market situation. But unless those assumptions are supported with a corroborative supportive information, this projection will not serve any purpose. Supportive information could be evidence of negotiation with the supplier for better price, a very robust cost-saving strategies, or a well negotiated borrowing terms with the bank, which will help the companies to operate properly. So this information could help the client to prepare a going concern assessment. And once they have the going concern assessment, the management can go back to one of those 4 scenarios which David Chetty has presented and decide what action that they need to take in the preparation of financial statement. So that's broadly the management can address.
So what I get from you is, one, management has to continuously revisit its assessment of going concern. It's not a one point in time job, and more so because of the uncertainty that we have at present in the market. And yes, the involvement of the whole entity, all the stakeholders within the entity, is required when we do this assessment. And like David stated, in as per IFRS 10, you have to see what has happened even beyond the year end when you do this assessment, right? So Umesh, I think this is a great guide for all the accounts team, I would say, or the finance team who work on this, to understand deeply on what they should do and how they should do and when they should do this going concern assessment, and how varied stakeholders are interested in that assessment, and more because of the uncertainty that we are facing now. So right now, I would thank all the speakers and panelists for this joining and sharing your knowledge and thoughts on this webinar. We come to a close with Umesh making the closing remarks. Umesh, over to you.
Thank you, Dilip. Now we are come to the closing part of the session. Today's session was kickstarted with excellent tone setting by Zaid Maniar, our international license partner, which is carried on by David Chitty, our international accounting and audit director, presenting exceptionally well on various technical concepts relating to going concern while preparing a financial statement. We were also privileged to hear directly from Sanket, an expert from the financial sector, who shared his views on certain consideration that the client should take while preparing a financial statement. Those were excellent insights for all of us. Of course, Dilip moderated this discussion very well. Now we are very close to the year end. Management should carry out the assessment for going concern if they have not already done so. Have early discussion with the auditor to avoid surprises. And management should not focus only on going concern assessment at the future projection only for 12 months. Now, with the current situation, this clearly warrants for the entities to look beyond 12 months, look for a longer period. Don't look at only your product segment. Look at the industry. Look at the market sentiments, and well incorporate these elements into your business plan. That would help you to make a very robust and comprehensive assessment of going concern. At Crowe, in fact, we had a discussion with most of our clients during our audit planning, interim audit stage, and on the client's assessment of going concern and what further action that can be taken. So since we had a discussion well before the year end, client also have some kind of time between the discussion to the year end and subsequently from the year end to till the completion of audit to update their going concern assessment. So in fact, if any of the client need a support on preparation of a going concern assessment, they can very well reach out to our assurance partners across the board. So that's broadly the message that I would like to give as a closing remark. With this, we have come to the closing conclusion of the section. And thank you all for joining, and wish you all a good day ahead. Thank you all.